Think of the national economy as a human body.
Okay.
And when you look at the government's accumulated debt service, it actually functions exactly like arterial plaque building up in the circulatory system.
Right, because it builds up silently,
Yeah.
day by day, year by year. That debt restricts the flow of vital nutrients to the rest of the body.
But the truly terrifying part is that the actual economic heart attack, it doesn't happen just because the plaque is there.
No.
The fatal event occurs at the exact millisecond that plaque breaks off.
Oh, wow.
And in financial terms, that rupture happens when existing investors look at the math, panic, and then they go from passively holding government bonds to aggressively selling them out of pure, unadulterated fear.
Welcome to Deep Cuts and Deep Thinking.
That is, wow, that is a really striking visual for how fiat monetary systems break down.
Yeah, it's grim.
It is. And what's fascinating about this breakdown, when you really look at it, is how entirely mechanical the process is.
Right.
So if an economic heart attack of this magnitude is just a mechanical failure of the system, why is everyone so consistently shocked when the patient collapses? I mean, we have entire institutions dedicated to monitoring the economy.
We do, yeah.
It feels like we must be staring at the completely wrong vital signs during the routine checkup.
Well, we are staring at the wrong vital signs.
Okay.
If you tune into standard economic reporting in the current era, the primary metric you hear quoted over and over is the debt to GDP ratio.
Right. You hear that everywhere.
Everywhere. It's treated as the ultimate baseline for financial health by pundits worldwide. But according to Ray Dalio's book, How Countries Go Broke, focusing on debt to GDP is a massive systemic misdiagnosis.
But wait, I always thought GDP was the ultimate scorecard. It represents the entire economy's output, right?
Right.
So it seems logical to measure your debt against the total size of your economy.
It seems logical until you look at the mechanics of actually paying bills.
Okay, walk me through that.
The government cannot use the gross domestic product to pay its interest obligation because GDP includes every cup of coffee sold, every software license purchased, every haircut.
Oh, I see.
Yeah, that economic activity belongs to the citizens. It belongs to the corporations, the private sector.
Not the government.
Exactly. The government does not own the GDP. It only has access to a very thin slice of that activity through taxation.
Okay, I see where this is going. So evaluating a country's fiscal health based on debt to GDP, that's like a bank approving a mortgage for a single family based on the total economic output of their entire neighborhood.
Yes, that is a perfect way to look at it.
Right, because the bank doesn't care what the neighborhood makes. They only care about that specific family's actual paycheck and their monthly bills. You can't pay your mortgage with your neighbor's salary.
No, you can't. And that is exactly what Ray Dalio is pointing out. The true vital sign isn't the size of the neighborhood economy, it is cash flow. Specifically, the amount of cash leaving the Treasury in debt service relative to the actual tax revenue coming in.
Right.
And when you look at the actual paycheck and monthly bills of the U.S. government in today's world, the math becomes staggering.
Okay, let's run those numbers. What does the family paycheck actually look like right now?
So Ray Dalio breaks down the current U.S. situation in his LinkedIn post, and he paints a very stark picture of the cash flow.
Okay.
The enterprise of the U.S. government brings in about $5.5 trillion in revenue.
That's the paycheck.
That is the paycheck. But it spends $7.5 trillion.
Oh, man. So before we even talk about the historical debt, we're bleeding $2 trillion a year in the present moment.
Yeah, exactly.
We're spending roughly 40% more than we actually take in.
Right. And because that deficit spending has been happening for a long time, the accumulated debt sits at $32 trillion.
$32 trillion.
Which is nearly 6 times the annual revenue.
Yeah.
And the interest alone on that $32 trillion is $1 trillion a year.
$1 trillion. Let's pause on that for a second, because that is money that doesn't build a single highway,
right,
doesn't fund a single school, doesn't secure a border or pay for a military base. It is purely the penalty for borrowing.
So the penalty, yeah.
It yields zero tangible benefit to the citizen.
And the burden of that penalty is immense. But well, the cash flow reality gets much darker.
How does it get darker than $1 trillion and nothing?
Because that $1 trillion is just the interest.
Oh, right.
The principal coming due, meaning the actual debt that is maturing and needs to be paid back or rolled over this year, is $10 trillion.
$10 trillion?
Yes. Therefore, the total debt service, meaning the interest plus the principal, is $11 trillion.
Okay, let me run that math slowly.
Yeah.
So the total tax revenue coming in is $5.5 trillion.
All right.
But the total debt service required to just not default is $11 trillion. That's 200% of the money actually coming in.
That is the reality of the cash flow. The government has to borrow massive amounts of money just to pay the interest, let alone the principal, let alone the actual operating budget of the country.
So this is the plaque?
This is the plaque accumulating in the system. Mm-hmm. As the debt service consumes more and more of the revenue, it slowly chokes out all other essential spending.
So if the cash flow is undeniably restricted, I mean, the plaque is there and it is really thick, how do we get to the moment of the heart attack?
Wow.
How do we go from this underlying chronic condition to an acute fatal trigger where the system just snaps?
The trigger is a phenomenon the author of How Countries Go Broke calls the death spiral.
The death spiral?
Yeah, it comes down to basic supply and demand.
Okay.
Because the government is running these massive deficits, it has to sell an enormous supply of new debt just to keep the lights on and pay off the old debt.
Right.
But investors are looking at the exact same math we just discussed.
Right. They see the debt service consuming 200% of revenue.
Exactly.
And if I'm an investor looking at a company or a country with those numbers, I would logically fear one of two outcomes.
Which are?
Well, either the government flat out defaults, or it devalues the currency by firing up the printing press to pay the debt.
And either outcome is catastrophic for the investor holding the bond.
Because if the government defaults, you get nothing.
Right. And if they devalue the currency, you get your money back. But inflation has completely destroyed its purchasing power.
Ah, I see.
So driven by that fear, the free market stops buying the debt. And worse, existing holders start dumping it.
That is the plaque breaking off. Sudden shift from holding to aggressively selling.
Ray Dalio points out specific red flags to watch for when this free market abandonment begins.
What kind of red flags? Like a lead indicator?
Yeah, exactly. A major lead indicator. First, you see the Treasury shortening the maturity of its bonds.
Oh, that makes sense. Because if I'm the government, and I know investors are terrified of what our money will be worth in 30 years, no one is going to buy a 30-year bond.
Nobody.
I have to offer shorter and shorter terms just to get anyone to take the risk.
The reliance on short-term debt is a classic symptom of distress. Another major red flag is net selling by foreign investors.
Okay.
International capital flight begins as foreign nations decide they just no longer want to hold the risk. Once these things happen, you enter the doom loop.
Okay, so if foreign investors flee and no one wants long-term bonds, the government is stuck holding a massive bag of debt that no one wants to buy. Doesn't that immediately force them to offer higher interest rates just to bait the hook?
Yes.
Which would just make the debt more expensive.
You've just described the mechanics of the doom loop perfectly.
Oh, wow.
When there is less demand for the bonds, the price of the bonds falls. To attract any remaining buyers, the interest rates, or yields, they must rise.
All right.
But when interest rates rise, the government's debt service costs increase even further.
So that $1 trillion interest bill we talked about, that goes to $1.5 trillion or $2 trillion.
Which makes the math look even worse, which makes the debt even riskier, which drives demand down further, forcing interest rates even higher.
It just feeds itself?
The spiral feeds itself until the free market completely refuses to participate.
Okay, but if the free market walks away because the math is terrifying and interest rates are spiraling out of control, the patient is dying on the table.
Yes.
Someone has to step in to prevent the immediate collapse, right? There has to be a buyer of last resort.
The buyer of last resort is the central bank.
Okay.
When the free market walks away, the central bank is forced to step in to prevent a catastrophic default. They basically become the emergency room doctor trying to revive the patient.
But in a normal business cycle, a central bank, like the Federal Reserve, they have traditional medicine, right? They lower interest rates to stimulate borrowing and get money flowing. But from what I'm gathering, this deep dive requires us to look at why their traditional medicine completely fails in the late stages of a debt cycle.
The failure is due to a late-stage phenomenon known as pushing on a string.
Pushing on a string. I like that. Where does that come from?
It's a brilliant term.
Okay.
It was coined by policymakers back in the 1930s.
Oh, okay.
Think about a physical piece of string. You can pull a string to restrict something.
Right.
Just as a central bank can raise interest rates to restrict the money supply and slow down an overheating economy.
You pull it back.
You pull it back. But you cannot push a string to move an object forward. The string just goes slack.
So in the context of a severe debt crisis, what does pushing on a string actually look like?
Well, when the crisis hits, the central bank implements what we call monetary policy 1.
Okay.
They lower interest rates all the way to 0% to stimulate the economy.
0%.
Yeah, 0%. They are trying to make borrowing incredibly cheap so people will take out loans, start businesses, and spend money.
But the string is slack.
The string is completely slack. The psychological terror of the massive debt crisis means that nervous savers, businesses, and investors stubbornly hoard cash.
Even at 0% interest, they refuse to borrow and spend because they're terrified of the economic landscape ahead of them.
Exactly. The traditional medicine is completely useless. The private sector just goes into survival mode.
You know, it's like a doctor administering massive, heroic doses of adrenaline to a patient in cardiac arrest.
Yeah.
But the patient's cellular receptors are completely burned out.
That's a great way to put it.
It doesn't matter how hard the doctor pushes the syringe, the body simply refuses to respond. The system is immune to the stimulant.
And because monetary policy 1 fails to stimulate the private market, the central bank is forced to move to monetary policy 2, which eventually evolves into monetary policy 3.
Okay, and what are those?
This is quantitative easing. Since lowering rates to 0% didn't spur the private market to buy debt and spend, the central bank decides to just print the money and buy the government debt themselves.
They bypass the free market entirely.
Entirely.
They invent the money out of thin air and use it to buy the government's bonds, artificially keeping the government afloat.
If you want to see the ultimate blueprint for how this plays out, Ray Dalio's LinkedIn post points directly to Japan.
Okay.
Japan has a staggering 215% debt to GDP ratio.
215%.
The highest of any advanced economy.
This sounds theoretical, but hasn't Japan been running this exact playbook for decades? I remember hearing their debt is astronomical, but they haven't actually defaulted.
No, they haven't.
Is that the path we are looking at?
It is the path, and it illustrates the consequences clearly.
Okay.
Because no rational free market investor wanted to buy Japanese debt at the artificially low interest rates Japan needed to survive. The Bank of Japan stepped in.
The doctor.
The doctor. They printed massive amounts of money. and bought an enormous percentage of their own government's debt.
So they avoided a technical default. But what was the result for the people who actually held Japanese bonds? Did the medicine work for the investor?
For the bondholders, the medicine was a disaster.
Really?
Because the central bank printed so much money to absorb all that debt, the currency devalued severely.
Oh, man.
According to the author's analysis, holders of Japanese bonds have lost 51% of their wealth relative to US dollar debt.
51%.
And a staggering 76% relative to gold since 2013.
Wait. The government paid back every yen they owed, but the investors lost most of their buying power anyway.
They lost it anyway.
The safe investment destroyed their wealth.
Exactly.
So this brings us to a critical structural juncture. If the medicine destroys purchasing power, and the doctor, meaning the central bank, just keeps absorbing all this toxic debt onto its own balance sheet to save the patient, what happens to the doctor?
This leads to the final climactic stage of the crisis. The central bank itself goes broke.
I am going to need you to walk me through the mechanics of that, because how does an institution that literally owns the printing press go broke?
I know, it sounds impossible, but it comes down to a fatal cash flow mismatch. When the central bank does quantitative easing, it buys long-term government debt at fixed, usually very low, interest rates. Let's say they're earning 1% on those bonds.
1% coming in.
To pay for those bonds, the central bank creates bank reserves, which are liabilities it owes to commercial banks. And it has to pay those commercial banks a floating short-term interest rate on those reserves.
Hold on, let me stop you there, because the phrase creates bank reserves sounds incredibly dense.
It is, yeah.
To a normal person, a reserve is just a savings account. Are you saying the central bank is basically opening forced savings accounts for commercial banks, crediting them with digital money to buy their bonds, and then paying the commercial banks fluctuating interest on that money?
That is a highly accurate way to visualize it. The central bank doesn't hand over physical pallets of cash, it just credits the accounts of the commercial banks.
Okay.
Those credited accounts are the reserves. The central bank considers those reserves a liability, a debt it owes to the commercial banking system. And to keep the system functioning, it pays interest on those reserves.
So the central bank is locking in a very low fixed income from the government bonds it bought, but its expenses, the interest it has to pay out on those reserves, are floating and can change.
Right. Now imagine what happens when all that money printing eventually causes inflation to spike.
Oh, I see.
To fight the inflation, the central bank is forced to raise those short-term interest rates. Suddenly, the interest rate they're paying out to commercial banks jumps to 4 or 5%.
But they are still only earning 1% on the trillions of dollars of government bonds they bought years ago.
The cash flow flips entirely upside down. The central bank suffers a massive operating loss. Their net worth goes negative. They are bleeding out, unable to make their own debt service payments from their earnings.
What is their emergency move when they can't cover their own losses?
The only thing they can do. They have to print even more money just to cover their own operating losses.
Which accelerates the currency devaluation.
And pours gasoline on the inflation spiral. It is a complete mechanical breakdown of the entire monetary order.
If this cycle is so mechanical and predictable, is there a cure? Is there a surgical fix to stop this before the central bank goes broke and takes the currency down with it?
There's a proposed solution.
Okay.
In his LinkedIn post, Dalio outlines what he calls the 3% three-part solution.
A 3% three-part solution.
Right. He argues we need a beautiful deleveraging. This requires the government to execute a highly coordinated maneuver to cut the budget deficit down to a manageable 3% of GDP.
Okay, but how do they bridge the gap to get it down to 3%?
It requires pulling 3 specific levers concurrently. Okay. First, cutting government spending by 5%. Second, increasing tax revenue by 5%.
Why?
And third, the central bank must lower interest rates by 1 to 1.5%.
Wow.
If any one of these levers is pulled too hard by itself, the economic adjustment is too traumatic. It has to be a perfectly balanced 3-part surgical strike.
A 5% cut in spending and a 5% tax hike. In this political climate.
Yeah.
You and I both know any politician who suggests that gets voted out by Tuesday, that's a political suicide mission, not a beautiful deleveraging. Yeah. I mean, we can barely pass a basic budget resolution, let alone engineer a flawless macroeconomic soft landing that inflicts pain on every single voter.
The historical realities support your skepticism completely. The political cycle is fundamentally misaligned with the debt cycle.
Yeah, it'd have to be.
The actions required to prevent the crisis, like cutting spending and raising taxes, they cause immediate visceral pain for voters. While the benefits, which are avoiding a currency collapse years down the road, are invisible and abstract. History shows that political systems rarely, if ever, have the discipline to execute this kind of beautiful deleveraging voluntarily. Usually the deleveraging is forced upon them by the crisis itself.
Because the math ultimately enforces itself. You can debate policy, but you can't negotiate with math.
The math doesn't care about political polarization or election cycles. If the deficit isn't managed through disciplined policy, it will be managed through the brute force of the markets when the debt buyers walk away.
So as we zoom out from the mechanics of cash flows, bond yields, and central bank balance sheets, what is the philosophical implication of all this? What should the listener take away from this mechanical breakdown?
Well, if we synthesize everything we've explored from these sources, the overriding takeaway is about the illusion of safety.
The illusion of safety.
Whether a heavily indebted country ultimately defaults in its bonds outright, or whether it avoids default by printing money and devaluing its currency, the end result for the investor holding those assets is exactly the same.
A total devastating loss of buying power.
Yes.
And that leads to a paradigm-shifting question that I really want to leave everyone with today. For our entire lives, we have been explicitly taught that government bonds are the ultimate risk-free asset. They are the absolute bedrock of every conservative retirement portfolio. But if history, math, and these mechanical cycles prove that fiat currencies and government debts are subject to a predictable, unavoidable cycle of devaluation and destruction, what does safe actually mean in today's world? Are our fundamental assumptions about financial risk completely backwards? If you enjoyed this episode, please like and subscribe.